If you just accepted a $75,000 job offer, you're not taking home $75,000. You're taking home somewhere between $51,000 and $60,000 depending on where you live. That's a $24,000 difference that nobody tells you about during the offer call. The gap exists because your gross salary runs through 4 separate deductions before it hits your checking account: federal income tax, FICA, state income tax, and whatever pre-tax elections you make. Most people find out about this gap when their first paycheck arrives and it's 30% smaller than they calculated on the back of a napkin. Here's the actual breakdown so you can budget correctly before you sign a lease you can't afford. This is for anyone making $75,000 at their first real job, or anyone about to negotiate an offer in that range. You'll learn exactly where each dollar goes, how much hits your account every 2 weeks, and how living in California versus Texas changes your take-home by $6,000 a year. This matters now because if you're apartment hunting or figuring out how much to put toward loans, you need to work with your net number, not the number on the offer letter. The IRS publishes their 2026 tax brackets every November. FICA is locked at 7.65% for everyone. State tax is where it gets messy. We'll run the numbers for both extremes so you know what you're working with. Federal income tax takes the first bite, and it's smaller than most people assume because marginal brackets don't work the way they sound. At $75,000, you land in the 22% federal bracket for 2026. That does not mean the IRS takes 22% of your $75,000. It means they take 10% of your first $11,000, 12% of everything from $11,000 to $47,000, and 22% of everything above $47,000 up to your $75,000. When you add that up, your total federal income tax is around $9,800 for the year if you're single with no dependents taking the standard deduction. That's 13% effective rate, not 22%. Run your exact number through the IRS Withholding Estimator. It's a free tool on irs.gov that asks for your filing status, salary, and pay frequency, then tells you what your employer should withhold per paycheck. The calculator also lets you adjust if you're claiming dependents or if you have side income. Most employers default to withholding slightly more than you'll owe, so you get a refund in April instead of owing. That refund is not free money. It's your own money the government held for 12 months at 0% interest. If your refund last year was over $2,000, you're over withholding and you should file a new W-4 with your payroll department to keep more per paycheck. The 2026 standard deduction is $14,600 for single filers. That amount gets subtracted from your $75,000 before any tax applies, which is why your taxable income is actually $60,400, not $75,000. If you're married filing jointly, the standard deduction doubles to $29,200, which drops your taxable income even further. This is also where pre-tax retirement contributions come in. Every dollar you put into a traditional 401k reduces your taxable income by $1. We'll cover that in a minute. FICA is 7.65% of your gross, and it comes out no matter what. FICA stands for Federal Insurance Contributions Act, which funds Social Security and Medicare. The breakdown is 6.2% for Social Security and 1.45% for Medicare. On $75,000, that's $5,738 per year, or about $220 per paycheck if you're paid bi-weekly. There is no deduction or credit that reduces FICA. It hits your gross before anything else. Your employer matches this amount, so the government actually collects 15.3% total, but you only see your half on the pay stub. State income tax is where geography becomes expensive. California charges 9.3% on income between $61,000 and $312,000 for single filers in 2026. On $75,000, California takes around $4,100. New York takes about $4,000 for the same income after their standard deduction. Florida, Texas, Tennessee, Nevada, Washington, Wyoming, South Dakota, Alaska, and New Hampshire have no state income tax. That's $4,000 that stays in your paycheck if you live in Tampa versus Los Angeles. Over 10 years, that's $40,000 assuming your salary never increases. The cost of living might be lower in Florida, but even adjusting for rent, The tax difference is real money. Some states also have local income taxes. New York City adds another 3 to 4% depending on your bracket. Ohio has municipal taxes that vary by city. If you're comparing job offers in different states, pull up SmartAsset's paycheck calculator and enter both locations with the same salary. The difference will show up immediately. This also matters if you're remote and your employer lets you choose where you live. Your state of residence determines your state tax, not where the company is based. If you work for a California company but live in Texas, you pay Texas rates, which is 0. One more thing. If you move mid-year, you file as a part-year resident in both states, and each state taxes the income you earned while living there. It's not double taxation, but it is annoying paperwork. Keep records of your move date and notify your payroll department so they update withholding. Pre-tax deductions reduce your taxable income, which reduces your tax bill. The two that matter most at $75,000 are 401k contributions and HSA contributions. If you put 6% into your 401k, which is $4,500 per year, that $4,500 never gets taxed at the federal level. Your taxable income drops from $60,400 to $55,900, which saves you about $990 in federal tax. You still pay FICA on the full $75,000, but not income tax. The money grows tax-deferred until you withdraw it in retirement. An HSA works the same way but better because it's triple tax-advantaged. You contribute pre-tax, it grows tax-free, and you withdraw tax-free for qualified medical expenses. The 2026 HSA limit is $4,300 for individuals if you have a high-deductible health plan. That $4,300 also comes out before federal and state tax. Combined with a 6% 401k, you've now reduced taxable income by $8,800, which saves you around $1,900 in federal tax compared to contributing nothing. Most people ignore the HSA because they're young and healthy. But even if you don't use it for medical expenses now, it rolls over every year and you can invest it like a retirement account. Health insurance premiums are also pre-tax if you're on an employer plan. If your employer charges $200 per month for employee coverage, that's $2,400 per year that reduces your taxable income. Same for dental and vision if they're offered. FSA contributions work similarly, but they don't roll over. Use it or lose it by year end. The FSA limit for 2026 is $3,200. You can't have both an HSA and a health FSA in the same year, but you can have an HSA and a dependent care FSA if you're paying for childcare. The actual take-home number after all of this depends on your state and elections. If you live in Florida, contribute 6% to 401k, max an HSA, and pay $200 per month for health insurance, your federal taxable income drops to about $47,000. Your biweekly paycheck after federal FICA and pre-tax deductions is around $2,090. That's $54,340 per year hitting your checking account. If you live in California with the same elections, your biweekly drops to about $1,920 because of state tax. That's $49,920 per year. $6,000 difference for the same job. Once you know your real take-home number, the next step is tracking where it actually goes. I use Rocket Money because it connects to your checking account and categorizes every purchase automatically. You set spending limits by category, rent, food, subscriptions, and it sends you an alert when you're close. It also finds subscriptions you forgot about and cancels them for you. The app is free for basic features. Paid is $6 to $12 a month depending on what you choose. I've been using it for 8 months and it's caught 2 subscriptions I didn't know were still running. Links in the description. Now you know what $75,000 actually becomes and where to put it.